Thank you, Durgesh Bhai, for those kind words. They mean a lot. It's a privilege to be here at this august institution, and a bigger privilege to be in the presence of the eminent investors and great human beings in this classroom today. Um, I used to be at Anam um, many years ago, and I cannot forget my experience there. And what I learned at Anam, not just about investing, but about life, about way of life, about people, about principles, I won't be forgetting for the rest of my life. There is one person today who's not here with us, but he's here in spirit, from whom I have learned a lot too. So I've learned long term investing from all my mentors, right from my father to Asit Kotecha at ASK, to Nimishbhai, Vallabhbhai, Manish, and from Rakeshji. Long-term investing is what I have practiced, what I've been passionate about. But I feel I've had the privilege of not just being an investor, but partnering with companies over the years in multiple ways. I used to run a program called shareholder value creation, which I used to provide as a service to companies while I was at my father's firm and then at Anam. And subsequently, I continued to do that at Rare, though not providing it as a service, but to our investee companies. I learned a lot in that process because I think very few investors get that privilege of being on the other side, of understanding how management teams and promoters think, of trying to teach them what drives value, what destroys value, of trying to share with them a decision making framework for them. But sharing a decision making framework is not enough. You have to change their mindset, their thought process. You have to change their language. I'm sure you remember the movie Black. There's this girl who's mute and deaf and is unable to speak. Once she learns the first word, it is then that her learning and communicating journey begins. In the very same way, that is how I engage with our investee companies. And to me, the most important North Star for shareholder value creation, or from investors' perspective, wealth creation, is the same, though the purpose is very different. So I have a formula. Wealth creation is a function of value creation. If the promoters and the management team do not create value, what wealth creation are we as investors going to participate in? And everybody talks about this value, and we say we are growth investors or value investors, growth at a reasonable price investors or deep value investors. What is this value? I feel that North Star, which is common to both, is terminal value. This elusive word, elusive idea, and elusive notion that we are referring to as value is terminal value. We know the price that we are paying to acquire the company. And Manish said rightly that the price that you pay for the company is the only thing in your control. But I will add two more factors that are in your control, which Mr. E.A. Sundaram also mentioned. What you are buying, at what price you are buying, and how much are you buying. All these three factors are in your control. Okay. As Michael Mabuse says, investing is a probabilistic game, right? So it is probability weighted. Every investor who buys a stock says, I have deep conviction. 20% below, the conviction evaporates. 20% above, the temptation to book the profit is there. Right? Therefore, very few people truly understand or appreciate terminal value. I'm here today to share my thoughts on terminal value. It is not definitive. It is very nebulous. Manish said very correctly that one should know oneself. Right? It is more difficult to conquer self than it is to conquer the world. So, walk with me today on that journey where we are trying to introspect. I don't have a single slide on data. It is a completely conceptual discussion that we are going to be having. I know that the superb presentations that have been before me have been outstanding, and therefore it's going to be very difficult to follow through on that. But I'm also happy that all those presentations happened prior to me, because a lot of things which I'm going to be saying were also mentioned there, and I'll try to connect all the dots. Let me start with this phrase. It's a quote by an investor called Chris Begg. You've probably never heard of him. He stays in Boston. He says, success does not lie in managing complex uncertainties, but in realizing unrealized simplicities. For emphasis, I repeat, realizing unrealized simplicities. Think about it. All of you have made a lot of money investing in stocks. How much complexity have you undertaken to invest in those stocks? Some of the best investment decisions at Rare, Rakeshji has taken with a lot of gut, with a lot of instinct. There is a Malcolm Gladwell book, Blink. I don't know how many of you have read that, right? So, build a knack for realizing unrealized simplicities. Terminal value is one such unrealized simplicity which will remove a lot of complexity from your investment process. So, I've tried to draw a chart which I call as the value chain of long-term investing. Everybody knows that the investment process is very simple. All you have to do is three things: buy, hold, and sell. You don't have to do a fourth thing. But how do you buy? I think Ramdevji quoted Thomas Phelps from the book 100 to 1, where he says you have to have the vision to see them, the courage to buy them, and the patience to hold them. How do you get the vision to see them? It's all very well to say you have to have the vision to see them. How do you get that vision? How do you get the courage, even if you do get the vision? Buying itself is an act of faith. Investing itself is an act of faith. And when you buy, there is an element of courage. But if you sell 20% below, or if you sell 20% above within 3 months, that is not an element of courage. So, what is the root cause of both this conviction and this courage? There is one very famous hedge fund manager who used the word variant perception. He said it, he used it in the context of trading. That to have a successful trade, you have to have a variant perception. When you are buying, somebody is selling. When you are selling, somebody else is buying. So there is always a variant perception. You make money when you have the right variant perception. Right? And as George Soros tells us, it is not how frequently you are right or wrong that makes the difference. It's how much money you make when you are right and how much money you lose when you are wrong. I submit to you that the root cause of this conviction and courage to buy is a differentiated insight. I'm choosing my words carefully. A differentiated insight. You all saw Rajiv Jain in action. What did you feel when you heard him out? What was your conclusion? Samir? Mm-hmm. Okay. Akshu?
The customers are going.
Gaurav? Okay. I'm sure all of you have met many management teams. Was he like meeting any other management team or was there a difference? Would you like to take a shot? If each one of you, I'm asking now this question to the same 4 people, if each one of you has to use one word which impressed you the most, what is that one word? Only one word. Detail. If I'm to use the same one word, I will use the word culture. Okay? Each one of us will have a different one word. But that different one word in your mind is your differentiated insight. Your ability to notice something exceptional, something unique, something which is enduring. You did not notice that he's saying that credit growth will be 17%. You did not notice that he's saying that he is going to add 9 million customers per annum. You notice that one word. And that one word is your differentiated insight. And whether that one word is articulated or not, every time that you are taking an investment decision, there is a differentiated insight. It could be one word, it could be one sentence. And you will find this unrealized simplicity in everything. When Rajiv was saying things, he said, if I can't capture it in one or two sentences, it means either I'm not thinking clearly or I'm not articulating it clearly. So, whatever is your differentiated insight, that is the root cause of your conviction. That is the root cause of your courage to buy. Your conviction is the root cause of the vision to see. Okay? Stay with me. Let's assume you have a differentiated insight. Let's assume that you built your conviction and you are now able to have the vision to see. And that does not mean that you will muster the courage to buy. Sometimes you will have the vision to see, but you will not have the courage to buy. Even though you have a differentiated insight, even though you have a conviction, because something else will cloud your mind. Something happening in Ukraine and Russia, or demonetization, or some interest rate hike in the US, it will cloud your things. So, just because you have a differentiated insight and just because you have a conviction does not mean you will have the courage. Let us assume that you have the courage and let us move forward. When you come to the phase where you are holding, how many times have you been shaken out from some of your best investment decisions? When the index is down 20%, are you shaken out or not? If you are, how can you hold? If the company does not perform for 2 quarters, do you get tempted to sell? During that time of holding, what is it that gives you the patience to hold? When markets are volatile, what is it that gives you the equanimity, the state of mind to hold? Again, it has to be your differentiated insight. And your differentiated insight could be different from mine. It need not be the same. So, even the root cause of your patience and your equanimity to hold is the same. It is the differentiated insight. That differentiated insight need not remain constant. The differentiated insight that Nimishbhai had when he bought Myco would evolve over a period of time. Investment is also an iterative process. Rakeshji held Titan for 20 years. during those years, he would have iterated his investment decision in his mind more than 200 times. Always deciding to continue to hold. But the iterative process continues. And therefore, your differentiated insight is important even in the process of holding. It may evolve, but it is imperative. Without that differentiated insight, it is difficult to hold. And very difficult to hold for a really long period of time. You may hold for 3 months, you may hold for 6 months, you may hold for 12 months. But to hold for 2, 3, 4, 5, 10, 20 is very tough. And how is your differentiated insight relevant when you decide to sell? Like Pulak Prasad said in his book, that he would choose not to sell at all. The only reason for him to sell is a break in his hypothesis, is when his differentiated insight is violated. But he is Pulak Prasad. We are lesser mortals. So, apart from that one reason, we also have other reasons. One is insanity, which means there are insane valuations. You heard some of the investors saying how they sold tech companies in November of 1999. They sold at the time of insanity in markets. They sold at 100 times earnings. And last is relative opportunities. We all work with finite investable resources. Therefore, if you do come across a very compelling opportunity, then you will do that. But in each of those elements, it will be your relative conviction, your relative courage, which will be important. And therefore, again, whether your differentiated insight is violated or not is important. If this differentiated insight is so important, where is this differentiated insight reflected? In your mind, you have to draw a picture which reflects this differentiated insight. It is that picture which is the terminal value. One can keep coming up with formulas, but it is that picture which is your terminal value. You're guided by that. That is your North Star. With that framework in place, we will move forward. When you buy, you're buying at price at the current market price prevailing at time t0. Okay? But when you're buying at price t0, let us assume that in your mind you have that picture, that terminal value, let us say terminal value in 10 years. Okay? Because terminal value is not in a short time frame. So let us assume that we are talking about a terminal value in 10 years. So when you're buying at price t0, in your mind there is a picture, whether quantified or not quantified, of a terminal value at time t10. In your mind, you do a comparison between the price at time t0 and the terminal value at time t10. When you are holding, you are validating whether the terminal value that you have in mind, that picture in your mind, is that playing out in reality. Am I right? And when you sell, let us assume that you sell at the end of 10 years, at that point of time, you're selling at a price prevailing at time t10. Now the terminal value of t10 at time 0 in your mind may not be the same and will not be the same as the actual price at time t10. So as an investor, how do we reconcile that? The journey from the buy decision to holding it to selling it, from price today to price tomorrow, I mean price at T10, is what we all travel. Now let us see the elements of that. This is the definition of terminal value in Investopedia. Terminal value is the value of an asset, business or project beyond the forecasted period when future cash flows can be estimated. Terminal value assumes a business will grow at a set growth rate forever after the forecast period. Terminal value often comprises a large percentage of the total assessed value. For all of us who have run models, you realize how large a portion of your NPV is terminal value. But this is a theoretical concept. As Manish explained, everything happens in cycles. It is not a smooth linear line, right? You may extrapolate anything in your Excel spreadsheet, but sales are not going to keep growing at 15% per annum. Margins are not going to expand at 50 bips per annum. We all know the Gordon's model, right? Dividend discount model for calculating terminal value. This is the formula. It has quite a few variables. You have to first project free cash flows in the, let's say, the next 5 years. Then you have to project the terminal value at the end of those 5 years, and then bring all of it to present terms. There are implied assumptions on growth and on dividend payouts. But all of these are complex uncertainties. We all decided right at the beginning that we will focus on unrealized simplicities. So let me quote John Maynard Keynes. He said, "I'd rather be vaguely right than precisely wrong." Right? That applies beautifully to terminal value. Investing is not running an Excel spreadsheet. Terminal value is not a number. If terminal value is not a number, the net present value of that terminal value cannot be a number. I learned from my father that direction is far more important than speed. So even if you are able to precisely calculate the terminal value, at most, how does it help you? You can figure out the exact IRR that you are going to get, the compounding return that you are going to get. But the fact remains that first you have to get the direction right. If you are getting into a train from Dadar and you want to go to Churchgate, you cannot sit in a train which is going to Borivali. To get that direction right, you need to have that differentiated insight. So let us understand some more context on terminal value. Would you agree with me if I said that terminal value is nebulous? If 5 of us had perfect information about everything about a company, we will still each end up with a different number. It is very much like the 5 blind men who are trying to figure out what an elephant is. They can't see the elephant, but they can touch and feel a different part of the elephant. And all of them, in their mind, have a different picture when they are touching and feeling that elephant, right? Will you agree with me that terminal value is distant? We are talking of 10 years here. For legendary investors like Nimish Bhai, it might be a 20-year terminal value. Will you agree with me that terminal value is not static, it is dynamic. It's constantly changing. The terminal value that you have in mind today will change 2 years from now. Somebody asked Rajiv a question, what do you feel about Jio entering the business, right? So when that question comes to your mind, what happens to that picture of terminal value in your mind? Does it increase or does it diminish? Right? So terminal value is dynamic. Terminal value is multivariate. It doesn't depend on only one variable. If there is a global liquidity event, the terminal value in your mind goes up or goes down. When Manish shares his learning on technology disruptions, the terminal value in your mind goes up or goes down. Sorry? So, terminal value is multivariate as well. My submission to you is that it is an unknowable truth. As Manish was explaining to us, rather than to struggle to fight to know that unknowable truth precisely, let us embrace that uncertainty as an investor. If you embrace that uncertainty, you are no longer in conflict. You are at peace in your mind. If you accept that terminal value is unknowable, then you are not struggling. And just a better state of mind helps make better decisions. Some of the speakers said or recommended strongly meditations. Some recommended Vipassana. Why? They said it makes you a better investor. Why? Because it puts your mind into a better state. Manish talked about getting Lakshmi, Saraswati and Durga together, right? It puts you in a better state of mind. So if you accept that terminal value is unknowable, you're in a better state of mind. Your decision making will be better. You must also accept that there are multiple states of existence. What do I mean by that? As I explained to you, for each one of us, for the same company, that terminal value is going to be different. But even for any one of us, it will be different at different points of time as well. Right? If one big assumption changes, suddenly it will be very dramatically different. But you are looking at it from your lens. For an investor from Japan, for example, if he was running a terminal value DCF, he will use a very different discount rate than what you and I would use. He will come up with a very different terminal value. And this terminal value lies beyond our horizon. When Manish was sharing all the technology disruptions, Nimish Bhai was sharing with us at lunch that a lot of those concepts are known to our traditional religion. Just because it is not articulated in scientific terms does not mean that it does not exist. So, we have to accept what lies beyond horizon. For each one of us, death is an inevitable reality. It is beyond our horizon, but we have to accept that inevitability. So, we have to accept terminal value. I want to share this video with you, and hopefully you'll appreciate what I'm saying better. Please bear with me. It is not about investing.
Thank you. Thank you to the Academy for this. All 6,000 members. Thank you to the other nominees. All these performances were impeccable, in my opinion. I didn't see a false note anywhere. I want to thank Jean-Marc Vallée, our director. I want to thank Jared Leto, Jennifer Garner, who I worked with daily. No. She said, why? I said, because my hero is me at 35. So you see, every day, every week, every month, and every year of my life, my hero is always 10 years away. I'm never going to be my hero. I'm not going to attain that. I know I'm not. And that's just fine with me because that keeps me with somebody to keep on chasing. So to any of us, whatever those things are, whatever it is we look up to, whatever it is we look forward to, and whoever it is we're chasing, to that I say amen. To that I say, all right. And to that I say, just keep living, huh? Thank you.
So, like his hero, we are chasing the terminal value. Right? Like him, we have to have that spirit of gratitude. Like him, we have to embrace that uncertainty. Also, let's look at terminal value not as a financial concept, but as a sociological concept. So there is Mark Weber, who's a sociologist, who says terminal values are the ultimate ends or goals that we wish to achieve. Do you remember the definition of strategy that Rajiv used? Plan of action to achieve long-term goals. He is also chasing that terminal value. His long-term goals are embedded in his terminal value picture in his mind. And his strategy is his plan of action to achieve that terminal goal. And as an investor, we are also participating in that process of him achieving that terminal value. It is value that something has of itself, independently of its relations to other things. This is a very important phrase here, because this tells you that that terminal value is an absolute concept and not a relative concept. We keep debating. HDFC Bank price to book is 3 times. ICICI Bank price to book is 2.8 times. Bank of Baroda price to book is 0.9 times. That is relative value. It is not terminal value. that terminal value arising out of your differentiated insight on whether it is HDFC Bank or ICICI Bank is an absolute concept. That terminal value at the end of 10 years is an absolute concept. You are not looking at that terminal value relative to Bank of Baroda or Axis Bank. It is independent of what Federal Reserve does between now and then. It is independent of what RBI does between now and then. As those things unfold, you may modify your terminal value, but the terminal value today at time t0 in your mind is independent of all the other things that happen in the interim. So, once it is not relative, terminal value has a very liberating effect on your mind. It unchains you from so many variables. Terminal value is not a value arbitrage. You are not trying to say that I am buying at 100. The picture of terminal value in my mind is 1000 after 10 years, and therefore the IRR between now and then is 22%. That is not what you are saying in your mind, because you don't know that 1000 is the terminal value. You cannot know, and you are very comfortable with the fact that you cannot know. But you know the direction, and that is what is important. Now, how do you try to make this terminal value a little less nebulous? If the 5 blind men collaborate, is there a way that that terminal value becomes a little more clearer? I'm submitting to you that there are 3 big lampposts or lighthouses that can guide you to that nebulous, unknowable terminal value. Not that you will know it, but it will be a little less nebulous. I'm saying that terminal value is a function of intangibles, megatrends, and leadership. Each of the 5 one-word definitions that we got from our friends today were intangibles. You said passion. You said passion. Somebody said detail. Energy. All of these are intangibles. It is the intangibles that drive that terminal value. You heard Rajiv talk about megatrends. You heard about the definition of megatrends that he had sourced from Google, which was, by the way, from BlackRock. Why is Rajiv thinking about megatrends? He's an operating manager. He's not talking to you as an investor in Bajaj Finance. But as I explained to you, value creation by the management team and wealth creation for the investor are both joined at the hip. They are one and the same. Therefore, he was also talking about megatrends. And I think we can all agree that Rajiv is an exceptional leader. And therefore, leadership is equally important in your perception of that terminal value. I'm not saying that these are the only three variables that impact terminal value. But I'm saying that these are the three lighthouses that can help us navigate the choppy seas of volatility and see, however vaguely, however nebulous, but try and make out our terminal value. So, what does this, what intangibles comprise of? Many variables. I've tried to put together a few. The first amongst all, and the most important to my mind, is culture. We all heard one of the speakers say, culture eats strategy for breakfast. In different frameworks, you saw different speakers talk about unit economics or distribution advantages. There was so much that Rajiv was talking about customer engagement. It is a non-quantifiable measure. It is an intangible. We all have invested looking at customer loyalty or brand. Manish was giving an example of Nestle in 2001, quoting at a market cap of 6,000 crores. What was he valuing? He was valuing the brand, the customer loyalty, the distribution. The current word for that is net promoter score. You saw net promoter score being measured by Rajiv. Employee loyalty. He kept talking about 12% attrition when the industry is at 22% attrition. Why? Because he knows that that is an intangible advantage that he has. And from Saurabh's presentation, you remember? Where he said that a small difference in those two pendulums, right? How that has an impact. Rajiv realizes what this 10 percentage point differential in employee attrition, what is the value of that? But do we realize that as an investor? Can we quantify that and say that that comprises 12.8% of the terminal value that I have in mind? We all realize the importance of governance as well. Now let us talk about megatrends. Rajiv talked about megatrends. We know they are structural shifts. Longer term, I must tell you that this presentation was made before Rajiv's presentation. They are longer term in nature. They have irreversible consequences, multiple dimensions, layers, and outsized implications that are difficult to fathom at the very beginning. When Nimishbhai bought ACC at what, 120 rupees, Nimishbhai? 100 rupees paid up? 500. Okay. He was not sure it was going to 10,000. So it is very difficult to fathom that terminal value fully right at the beginning. And this terminal value transcends geographies, generations, and governments. Why? Because it reflects the capabilities of the management team. You know that that management team will navigate all of those obstacles. It will navigate and overcome all of those challenges. When Kuntal invested in Bajaj Finance, he was not aware that someday we will have an Oaken or an authorized account administrator. But Rajiv realizes how big a delta it is to the terminal value in his mind. And he will navigate it accordingly. The reason I'm continuously using examples from Rajiv is not because I'm recommending Bajaj Finance, but because you've just heard all of that. I'm helping you draw the connections, right? Which is what Steve Jobs told us, right? Connect the dots. Let's come to leadership. Now, when we talk about leadership, it is not just leadership of the company, but leadership in the marketplace. Rajiv talked about leadership in market share, leadership in the profit pool, or he used the word profit share. He also talked about being number 1, 2, or 3 in each of his product lines. You will have and will be able to sustain leadership only if you have significant intangibles, far more than your tangibles. If you have leadership, you will have profitability, scalability, and durability, or else that leadership is not sustainable. If you have leadership, it means you are battle tested through multiple cycles. If you've navigated multiple cycles, it means you have resilience and adaptability. He talked today about how both demonetization and COVID were significant tests of their risks, of their risk models, were significant tests of their resilience. And he admitted that he himself did not expect his own resilience to be that good. Capital allocation and capital structure, very important. How many financial companies will say that between risk and growth, choose risk? How many finance company CEOs will say that if my risk head is telling me something and my business head is telling me something, and if both of them are differing, I will listen to the risk head? That itself is an intangible. Management depth and transition. He talked about how rigorous his process of strategy, planning, execution is. If you get an intersection of these three, you can be sure that the terminal value is very significant and very material. They will have disproportionate impact on terminal value. It will not be a 1 sigma, 2 sigma event. It will be 3 sigma, 6 sigma, 9 sigma or more. The traditional valuation metrics cannot reflect this outlier event appropriately. HDFC Bank, since the day it listed, has always been expensive. And if you did not buy it because it was expensive, you did not participate in that phenomenal run of compounding. But that is because we lacked that differentiated insight. If I submit to you that HDFC Bank was a retail lender, was not doing mortgages, he had a short duration asset book and a short duration liability book, therefore was not vulnerable to interest rate risks, and was still delivering 20% growth, 20% ROE with 20% capital adequacy. And because of these factors, he was the only bank which had earned the right to be valued on a PE basis rather than a price to book. That is differentiated insight number one. But there is a more important differentiated insight being derived from this differentiated insight number one, which is HDFC Bank was not the most expensive bank in the world. It was the cheapest proxy to consumer stocks in India because it was a leverage play on India's consumption, because it was a granular retail book. And the moment you looked at it from that perspective, HDFC Bank at 4 times book or 4.5 times book at 20p was not the most expensive bank in the world, but was the cheapest consumer proxy in India. With these two differentiated insights, you could have held HDFC Bank for 20 years. You did not need to do highly complex analysis. You had to be clear that this was an exceptional management team with an exceptional execution track record, with a very differentiated business model, with leadership in multiple product segments. It had 30% market share in credit cards. I talked a lot about intangibles, right? And we said that the 3 variables impacting terminal value the most are intangibles, megatrends, and leadership. This is a study of how valuations in markets have moved. In 1975, intangibles amounted to 17% of the market cap. In 1985, that rose to 32%, going up to 90% in 2020. So, intangibles are the dominant framework in today's markets. These soft assets, intangibles are soft assets, they are not hard assets, give today's companies their hard competitive edge. The competitive advantage that Rajiv Jain has at Bajaj Finance, where he is not afraid of Jio coming in, is not that his net worth is so much. He knows the value of the team that he has built, of the culture that he has built, of the business model that he has, of the execution capability that he has. Hence, thinking beyond the value, the labels of value and growth is critical. As one of the speakers said, that being a value investor does not mean that you are buying cheap. And if you believe in what we have been discussing today, then you should think of yourself as terminal value investors rather than being a value investor. So, this is the difference between tangible assets and intangible assets, and how that is reflected in the 5 largest market cap companies from 1975 onwards, how they have changed. In a recent report by Counterpoint Global, I'm sure most of you would have read that report, Michael Mauboussin is one of the authors. He says that the way we account for intangibles is wrong. We are charging all the intangibles to the P&L. If they were tangibles, they would be taken to the balance sheet. So if you make that accounting adjustment for intangibles, then the blue dots represent the way results are reported. And there are two variables here that are being tracked. One is NOPAT margin, and the second is invested capital to turnover. And the intersection of these two gives you your ROIC, right? However, for every blue dot, there is a red triangle. The red triangle is the adjusted NOPAT margin and the adjusted invested capital to turnover ratio for those very same companies after adjusting for the intangibles. Now, I'm sure a lot of assumptions have gone into this, but what it shows is you have companies which are concentrated along the x-axis and along the y-axis, both. They therefore represent two very different kinds of companies. Those which are along the x-axis represent companies which are focused on differentiation models. And those along the y-axis represent companies which are focused on cost leadership. I think some of Nimish Bhai's most storied investments are also along the cost leadership vertical. So it is very, very fashionable to talk about only differentiation based companies. But let us not forget that for every apple in the world, there is a JSW Steel, there is a Shree Cement, there is an MRF, and so on. There is a Myco. When you get the combination of differentiation and cost leadership, then that is nirvana. Let me show you a few examples of specific companies. This is from the same report, where again the blue dots represent the reported numbers and the red triangles represent the adjusted numbers. And you will find that for every company, the red triangle is below the blue dots, right? Why is that? Because the invested capital number is expanding. As intangible assets are shifted from the profit and loss account to the balance sheet. Okay? It is critical to note that not just the movement towards the bottom right is important, but also the distance the companies travel following the adjustment. So you will find that the adjustment is the distance traveled is the greatest for Apple. And you will find Apple to be in the differentiation zone, Microsoft to be in the differentiation zone, Alphabet to be in the differentiation zone, but Walmart and Amazon to be in the cost leadership zone. So this is just to reflect the importance of intangibles and how to think about intangibles, because it is very difficult to capture intangibles in numbers. Now, after intangibles, let us come to the second most important variable, which is megatrends. So I had picked exactly the same quote on megatrends that Rajiv had picked. This is a definition of megatrends by PwC. And This is by John Nesbitt. He's the person who actually coined the term megatrends in the 1980s. So I'll leave you with this thought that megatrends are inevitable, irreversible, and irreplaceable. Your understanding of these megatrends will help you to understand your differentiated insight with regard to the terminal value much better. And I keep re-emphasizing the same words because, like the movie Black, once we get the words in place, once we get the language in place, that is how we learn, that is how we think. So some of the megatrends that we talked about, okay? We talk about the demographic dividend, consumerization, financial deepening, digitalization, urbanization, climate change, artificial intelligence, women empowerment, nuclear families, renewables, EV and autonomous vehicles, digital public infra. I can think of many more. You don't have to catch every mega trend. You just have to catch a few. The ones in which you can build your differentiated insight. You saw the word circle of competence in Manish's presentation. If you don't build that circle of competence, you will never be able to build that differentiated insight. It does not mean that you have to be closed to new business models at all. It's that you have to keep learning and keep expanding your circle of competence. Now let us come to the third vector, which is leadership. And I draw parallel to gorillas. And you will understand why I call it gorilla investing. This is the picture of a gorilla. And these are the characteristics of a gorilla. There are many monkeys in a jungle, but very few gorillas. What does that tell you? Gorillas are rare. Right? Gorillas are outsized compared to monkeys. What does that tell you? Gorillas are dominant. What was the word that Rajiv had in his presentation? Omnipresent and dominant. When you find dominant companies, don't let them go. Gorillas are not challenged by monkeys. What does that tell you? They have moats, they have knights. Gorillas have a lifespan double that of monkeys. Longevity is an essential characteristic of leadership. You cannot have superlative investment returns without longevity. Remember when Ramdevji quoted Thomas Phelps? He said, patience is the hardest of all the three. Amongst vision to see, courage to buy, and the patience to hold, he says patience is the hardest of all the three. So longevity is important not just for your investee companies, but even for your investment conviction. So every day you should go down on your knees and pray that you find the right jungle, which is the right megatrend, and the right gorilla, which is the leadership. If you get intangibles, megatrends, and leadership, three things, you are not very far from terminal value. I have this 5L grid, as I call it. You can classify every company in the market amongst these five. The maximum number of companies you will be able to put in lallus, then in losers, then in laggards, few in leaders, and even fewer in legends. Terminal value is derived from a lot of intangibles, but fundamentally, those companies have to have scalability, adaptability, and resilience. Manish and I have grown up hearing the word PSPD, right? That Mr. Narayan Murthy used to talk about. Profitability, sustainability, predictability, and de-risking. Those factors are captured here: scalability, adaptability, and resilience. Also, please remember, terminal value is applicable only to leaders and legends. It is not sustainable for the other three buckets. So don't even waste your time thinking about that. If you deploy this framework, out of the 7,000 listed companies, you'll be able to come down to maybe 300 companies on your radar at best. Just imagine how, with such a large quantum or magnitude, you have improved your odds substantially. You will find that I have not talked much about governance, character, and capital allocation because I believe they are table stakes for leaders and legends. So I'm not using those as filters because the premise is that they have to be there if you're thinking about leaders and legends. With the concept of terminal value, very important concept attached to it is value migration. Because the source of terminal value itself is value migration. What is value migration? From the book Value Migration by Adrian Slivotsky, flow of economic and shareholder value away from obsolete business models to new, more effective designs that are better able to satisfy customers' most important priorities. Value migration occurs when there is a disconnect between customer priorities and existing business design. It is for that reason that Rajiv spent so much time in his planning cycle. That is why he's bothered about mega trends. That is why he's bothered about all those variables that he talked about. He talked about product, channels, technology, and one more. What was that? There are many types of value migrations. Value migration across geographies. So whole China plus one framework means that there is a shift of value from China to other countries. Like Joseph Schumpeter says, creative destruction. When there is creation somewhere, there is destruction somewhere. Like energy, it cannot be created nor can it be destroyed. It can only change form. Value migration within the country, unorganized sector to organized sector. Value migration within the industry, from weaker players to stronger players, from the less adaptable to the more adaptable. Incumbents versus challengers. Value migration within the company. Rajiv mentioned The company has gone from a business model which was predicated on a B2B2C model to a direct-to-consumer model. That's a shift of value within the company. Manish talked to us about disruption and how that disruption is going to be changing, to be driving value migration. These are some of the variables you can use to determine value migration, but there are many more. However, I want to emphasize two things here. The pace of value migration has gone up, as Manish was showing in one of the charts, right? One of the first charts, that parabolic curve. And the quantum of value migration has changed. When Microsoft moved to a subscription model from a license model, that change in its business model drove so much value migration, it's not funny. So remember that the pace and the quantum of value migration have gone up in a parabolic manner. And how this value migration is being compressed in time, because the disruption is being compressed in time. And it is not only technology disruption that we are talking about, but business model disruptions. Or even when Rajiv was talking about Starbucks, he talked about how they are using multiple formats, right? Like an airport kiosk, or he used some of the, he gave some other examples as well. So the pace of change and the quantum of change, both are undergoing a parabolic shift. And in many cases, this value, the quantum and the pace of value migration may not be apparent in the beginning. You will not always know. In fact, you will probably most of the time not know the quantum and the value of the migration. But as I said, the direction is important. The degree you need not get right, but the direction is important. I talked about incumbents and challengers, so I want to take that concept a little further. If you can classify all companies within two buckets only, which is incumbents and challengers, then my submission to you is that the two most important variables to think about are scalability and adaptability. Okay? As Charles Darwin said, it is not the strongest of the species that survive, but the most adaptable. So that gives us, Manish taught me how to use 2x2 matrix in everything. So I'm sharing what he taught me over the years. You have this 2x2 matrix. If you assume that most incumbents have already scaled, and if you assume that most challengers are already adaptable, otherwise they wouldn't be challengers, then what is it that you are seeking? You are seeking incumbents who are adaptable, and you are seeing challengers who are scalable. That's the holy grail. Adaptable incumbents and scalable challengers. So in your preferred investment framework, when you are thinking of your terminal value, try to fit within one of these two buckets. If you're not able to fit one of these two buckets, then there is something which is wrong somewhere. Adaptable incumbents or scalable challengers. Now, we've talked about companies, but as Manish said, you must understand yourself and where you stand amongst so many investors. So I'm using some estimates. I have no basis for those estimates. But again, my objective is to be vaguely correct than to be precisely wrong. So it is my submission to you that 90% of all investors or all market participants are playing in the 0 to 1 year time bucket. That 8% are playing in the 1 to 3 year time bucket. That 1.5% are playing in the 3 to 5 year time bucket. And 0.5% are playing in the 5 year plus bucket. Manish, would you say intuitively this is right? Or sorry? Okay. It is the 5 year plus bucket where all the terminal investors are housed. You cannot talk about terminal value investing and then be in the 0 to 1 year bucket. The short-term market participants, they focus on IRR. They face reinvestment risk and they face tax inefficiencies. It is the long-term market participants who focus on terminal value, which is the more than 5 year time horizon. And as I shared with you, legends have 20 year plus time horizons. So as we've all understood, the competitive intensity for terminal value investing is much lower than for IRR investing. The IRR players are in the 0 to 1. Now that does not mean that I disrespect anybody in the 0 to 1 bucket, because that is what works for them. I am choosing to play this game. In the book Art of War, Sun Tzu says, choose your battlefield. Bhagavad Gita says, choose your karma bhumi. Therefore, as Manish says, know yourself. Can you be in this bucket? Is this for you? Only then terminal value investing is for you. Now, I want to take up this one case study to put together all the variables. Okay? This is the proportion of global automobile sector that EVs will capture. Up to the year 2022 is the actual data in terms of market share. And the 2030 number is an estimate. Okay? So this is the parabolic phase. Please keep this picture in your mind as we move forward. This is factual data, no rocket science here. Again, this is factual data. The market cap of the two EV leaders, which is Tesla and BYD, as compared to the 10 largest non-EV players. This is a comparison of those. The green line is Tesla plus BYD. The other line is the top 10 non-EV players. So, you can clearly identify the parabolic phase and correlate this to the previous picture. You will find that how the terminal value is playing out. Okay? Now, keep this picture in your mind as well. So keep the first picture and keep this picture both in your mind. And keep the 0.5% of the terminal value investors picture in mind too. So now we will combine all these three charts. You saw this, So, the 2022 global EV penetration was only 13%. But the market cap of those two leaders in the EV space was greater than the top 10 non-EV players. That is the value of the disruption. And it is very material. We are talking of $1 trillion plus. And only 0.5% of the investors participating in that. So you can now identify that point of recognition. I'm not saying that this 0.5% set of investors recognize it here. I'm saying that this is the point of recognition where it becomes obvious to the rest of the market. And the rest of the market scrambles. Till then, it is not obvious. It is like a tsunami. It becomes obvious only when it comes close to the shore. Okay? The point of recognition is also important. Just as Manish said that the pace of change and the quantum of change have become parabolic, how fast is the market recognizing this change is equally important. Because if the market is recognizing it faster, it gives you a shorter time to react. So now let me create a theoretical construct of T0, T5 and T10. This is the price move. This dotted line is the market share move. The second dotted line is at T0 when the market share is, let's say, 3%. At that time, you buy at a price at time T0, keeping in mind the perceived terminal value at time T10. And when you are holding in the interim, the market share, the 3% market share has moved to 12%, where your hypothesis is playing out. And eventually at T10, the market share goes to 35%. But the actual price at T10 is different from your perceived terminal value. And that's fine. And at that point of time, you decide and you choose whether you sell or not. And again, one brilliant chart in Manish's presentation was how from one parabolic curve, there is a transition to a second parabolic curve and then a transition to a third parabolic curve. And this is the point of recognition where it becomes obvious to the rest of the market. And this is the 0.5% market participants who are participating in that. So as Eric Smith says, change happens slowly and then suddenly. So the price performance until the point of recognition is when the change is happening slowly. And the price performance after the point of recognition is when it is happening suddenly. So my submission is that terminal value is the most important determinant of long-term investment compounding returns. Value migration and longevity drive terminal value. Intangibles, megatrends and leadership drive value migration and longevity. The quantum of value migration is rising at a parabolic pace, and the pace of value migration is also rising at a parabolic pace. And the recognition of value migration is happening faster. Investors focusing on terminal value are very few in proportion, leading to lower competitive intensity. if I am to put all of this together in a graphic form, this is the picture. And in your mind, all of this has to be captured in those two variables. The price at T0 and the terminal value T10 at the time that you're buying at time T0. Very simple, but not easy. So I will now try to rephrase the Thomas Phelps quote that Ramdevji used. The vision to see them, the courage to buy them, the patience to hold them, and patience is the rarest of the three. This is the rephrase. The vision to see value migration leading to terminal value, the courage to buy the terminal value at that point of time, and the patience to hold the terminal value playing out. Patience is still the rarest of the three. And these are the parting thoughts, the last two quotes from my side. This is a quote from the movie Wall Street, where Gordon Gekko says, "Money itself isn't lost or made, it is simply transferred from one perception to another." So, money, essentially, value is transferred from one person's perception of the terminal value to another person's perception of terminal value. Most people overestimate what can happen in 2 years, but underestimate what can happen in 10. There's Bill Gates. And which is why you can ask any of the investing greats in this room, right from Rameshji to Nimish Bhai to Durgesh Bhai or to Manish, and they will tell you that they have systematically underestimated their returns over a time frame of more than 10 years in almost every stock, every multi-bagger that they would have had. Thank you. Questions? I know this is not the best thing to be discussing on a Saturday night. After such fantastic presentations and a great dinner. Thank you for bearing with me till then. I had promised Durgesh by 1.5 hours. I finished in 1 hour 37 minutes. Everyone.
Utpal bhai, in today's very fast moving world, the terminal value that you are estimating 10 years hence, sometimes it is happening in 6 months or even 18 months, 6 to 18 months also, especially what's happening there in the West. So when that happens, what do?
You reassess. So as that famous quote is, when information changes, I change my view. What do you do, sir? Right? So you reassess and then decide. Maybe there is a factor which is influencing your terminal value again. You don't know. That terminal value that you had before you bought is not constant.
Yes.
It's dynamic.
Yes. But if it...
I will not try to optimize. Because for me, getting the direction is right. Getting the direction right is more important than getting the degree right. I don't mind. I will hold. I will hold. If I feel at the terminal value, I will reassess, but I will still hold. Yes, I will still hold. you reassess. You don't, what are the variables that have changed? You must reassess. After reassessing, you may come to the conclusion that you should sell it. That's fine as well. But you will reassess. You will not just blindly sell just because your vague concept of terminal value has arrived. As Manish explained about what Manik Bhai used to do, if you sell, you could miss the parabolic part of the rise. That is why you will not sell. But what he was doing was moving it to the momentum bucket. I am not moving it to the momentum bucket. Because I am not a value investor, I am a terminal value investor. I'll keep holding for the terminal value. If you feel it is perception game, then in your opinion, the terminal value is lower than the revised price. Then you have to sell. But all I'm saying is reassess at the end of 2 years when that big move has happened. That's all. Sorry.
Also give a concept about the 5 buckets where you have a lot of times when you're trying a mega trend, it's up. Companies are not really in that bucket because we really don't know who will turn out to be. How does one work on that?
It's a lot of work, but you will be able to assess. There are people in this room who heard Rajiv present many, many years ago. Which year was it, Kuntal, when Rajiv presented first? And from that one lecture, they realized that there is a big terminal value here. They all bought.
What was?
Go ahead.
I thought you pressed.
So as I told you, I chose to use the terminology of differentiated insight rather than variant perception, because variant perception seeks to exploit a gap between perception and reality. Here, I am not seeking to exploit a gap between perception and reality. I am seeking to exploit a gap between the perceived reality today, and the perceived terminal value 10 years from now. That is why I choose to use a different word, which is differentiated insight rather than variant perception.
So thanks a lot for that. Just practically speaking, do you translate the 10-year value into some sort of a price in addition to sort of the drivers? You don't try to put a number to it. And then I'm curious, so if you're doing the comparison, the situation which you said you might sell is if it goes into a mania territory. So I'm just trying to get a sense that, obviously with this, you will hold on if it runs ahead of what non-terminal value investors would consider to be fair.
Yes.
But then I'm just trying to understand at what point does it, might cause you to be...
long rope. I'll give it a very long rope.
Yeah. Thanks.
As I said, I'm not trying to quantify it. No, so I'm not even using DCF. As I said, I'm not trying to quantify terminal value. To me, it is a nebulous concept, right? But just because you can't see something clearly does not mean that it does not exist, right? For example, if you are at Everest Base Camp and you're not able to see the peak, you're able to see something hazily, but not clearly, does not mean that Mount Everest is not there.
But I guess the one of the slides you had intangibles greater than intangibles. Then the list of the intangibles and the differential insight on that. And I guess in that case, as long as there's longevity, both the underlying megatrend and this equation, then kind of what you're saying is you can't put a number to it. But if that equation holds true, then you kind of
Yeah.
you'll hold between what is
So then you know you are at the base camp. You can't see the peak,
right.
right? But you know the Mount Everest is there.
Directionally, you know it's there.
Yes. So getting the direction right is more important than getting the degree right. Reassessment is intangibles greater than the price prevailing at that time. Yes. I'm saying for companies which have leadership characteristics, you will always find intangibles to be greater than the tangibles. That's all. Yeah, if that equation changes, it breaks. Yes. Yeah. Yes. If that intangible is lost, it is a break of hypothesis. That's okay. But then you are not with the right partner.
Yeah. On this is terminal value is very difficult to assess, like you said. Okay. Now there are so many moving pieces. One, whatever you give, the rate of terminal growth, normally terminal value would be more than 50% of the total present value. Now that is so which means that you're projecting a very long headway for growth. Even if that changes from 4% to 5%, it makes a big difference. So that's one moving piece.
No, but I told you that while that is the formula, I am not calculating it
No,
at all.
so what I'm trying to say is that we also know, okay, there's a mega trend which can actually disrupt few things. You don't know the extent of disrupt. That's a moving piece. Another moving piece is that the longevity of companies is also coming down globally or in India. And then you have all these, black swan events which had a higher, time frame that is also shortening. So as we speak, there is the news that Putin has fled Russia. Okay, there's a conflicting news also that he has not. His plane has gone out of radar. Now, in this type of VUCA world, you said that you have a differentiated insight. That is also a moving piece because what insight you have and what others would be different. That's why it is differentiated. And you also said that you need to constantly evaluate this. You didn't say the period, but you were saying to a question 2-year period. So when you assess this, suppose we also know that 80% of the time the stock doesn't move. 20% of the time it makes that 80% move. You have got that move, but now you're evaluating. Directionally, still it is positive.
Then I'll hold.
You will hold it.
I'll hold.
You will not worry about what is happening on the world and the stock crashes 80%.
To me, it's noise.
Okay.
If it crashes 80%, I will revisit my hypothesis. No, either to buy more or to sell. You cannot prejudge your revisiting the hypothesis, no? Agreed. So I will revisit my hypothesis. If nothing has changed, I will buy more. Sorry?
Oh no, we
sorry.
are all in line. I found it interesting that you used one word, culture, which Rajiv also used a lot, and I didn't get a chance to ask him the question, so I'll ask you the question. In your experience, as an outsider, when we evaluate companies, right? What are few things that you look for as torchbearers for culture? And a follow up to that would be how can we minimize errors, both false positives and false negatives? In your experience, if you can share a few examples.
So the point is that false positives and false negatives arise from errors on multiple variables besides culture. But coming specifically to culture, culture has a lot to do with the people, which is why one other word that Rajiv used is people capital. You will find those leaders who think about culture, who think about people, they are just behaviorally different. And they will have different characteristics. Many years ago, a Brijmohan Lal Munjal, who would not be so articulate, would have very different characteristics from a Rajiv Jain. A Narayan Murthy would have very different characteristics. So there is no checklist on that, but some common elements are frugality, sincerity, thinking of others. Like Manish said, is that person in general a giver or is he a taker? Right? It's about whether that person has a purpose, whether he has a passion. And is he able to transmit that purpose and passion to the rest of his team? Like when I first visited Titan, I was visiting the factory and there was a factory worker who was only 10th standard pass. And I asked him, I was trying to be smart, I asked him, what is your annual target? He said 30%. It's so 30% growth over last year. I was hoping that I'll get some inside information on the growth target. He said, no, sir. This machine costs 1 crore rupees. So I have to generate at least 30 lakh profit from this machine. So when I realized that a 10th standard pass factory worker is thinking of return on capital employed, though he was not voicing it in that way, it means that that company had the right culture. At that time, Titan was loss making. But that culture. And there are so many different dimensions to culture, but you can sense it. Like I'm sure in this one session, you can sense that from what Rajiv spoke. So I would not recommend having a checklist. I'm not sure if I was very helpful on that, but it is what it is.
Named a few. Maybe just any false negatives, like in the early part of your career, you look for certain things as red flags, but over time you chose to, learn to ignore them.
I would look for complacency or loss of hunger. At the same time, loss of reality. As Manish said, many times, a lot of promoters, once they make some money, they lose sense of proportion, which results in wrong capital allocation, which results in company becoming imprudent or taking on outsized risks. Yeah.
Typically, I just wanted to check about this culture. We talk about assessing culture, but there is also a bias which is called the halo effect, right? That if the stock has done well, then the culture would have been great, and the CEO is great. And I'll just quote an example of John Chambers when Cisco was the largest market cap company. On the same time when they achieved highest market cap, I think there was a article by Fortune that there is something about Cisco. And everybody said that he's the best manager and they've got the acquisition engine right, everything right. 1 year later, when Cisco crashed, same Fortune magazine on the same day wrote another article, there's something completely wrong about Cisco. And so, the same manager who was considered to be the best one, within 1 year was considered to be the worst one. So how should one think about, because it's very nebulous to think about culture, somebody you may think is great, or, in many meetings, we all come out with different judgment of the same management. How does one sort of, yeah? Yeah. Yeah. It's so difficult to sort of assess culture.
I agree. It is very difficult to assess culture, but you are talking of a bias. the bias has everything to do with you. Nobody is asking you to accept what Fortune magazine is telling you, right? You have to come to your independent assessment about the culture. There can be a halo effect, but it is up to you to remove that bias. You may still make a mistake. I'm not saying that we've not made mistakes. We made mistakes.
No, but a lot of times, our opinions so what an opportunity to meet Rajiv. But a lot of times our opinions also get formulated based on, annual reports we read, which are also promotional in nature, news articles that are read. So a lot of times we see them on TV, and again, most managers on TV tend to be, very, very, very promotional and look also very confident, and, a lot of the body language is similar.
So look for inconsistencies, look for deviations from your hypothesis, but also look for subtle hints. So I don't know if you've read Sherlock Holmes. Once Sherlock Holmes visits a stockbroker, okay,
That's good.
and Sherlock Holmes is worried that it may rain. The stockbroker tells him, "Don't worry, I assure you it is not going to rain." He hears him out and then walks home. It has still not rained. He tells Watson, "Don't deal with this broker." He said, "Why do you say so?" He said, "Because he said, I assure you it will not rain." He says, "Yeah, but it has not rained." He says, "That's not the point."
How can he assure?
That he was willing to make a false assurance is the point. It was not something he can know. He did not even couch his statement with any conditional statement.
Right. On the other point, just on this, when you said that you'll give them a long rope, so just as an example there, Cisco, for example, was doing everything completely right. The valuation went up and went up. And at that point of time, if somebody gives a long rope, the price has still not recovered. How does one think about building some guardrails around if there are manias?
It's okay if the price is still not recovered. What you have to figure out is whatever has not worked out, is that temporary or is it structural? If it is structural, it is a break of your hypothesis, sell. If it is temporary, persist with it. It's okay to underperform for some time.
Understood.
I think everybody's tired.
But I just was wondering how this would relate to Titan. Like you said, maybe over the 20-year period, there are 200 times this may have been reassessed. Just if you could touch on maybe what were those moments, because the mega trend I think was intact, it's still intact. Then were there I think 2003 there was some inflection point, I think is what somebody had mentioned. Could you just talk about that and how you apply this to that particular?
No, during these 20 years, a lot of variables came through. Okay. The company had started gold leasing, which was a dramatic change in the business model. At some point of time, the government had imposed import duty on gold. Then GST was imposed on gold. Then the government came out and said that you cannot run the golden harvest scheme as it is, because it tantamounts to you taking public deposits, right? And then for a brief period, the government had banned import of gold. Various changes happened. The company went into newer areas like eye care, saris. There was a change of management from Bhaskar Bhatt to Venkat, right? A lot of variables kept changing. Every time those variables changed, you would reassess. Then once Warburg Pincus invested into Kalyan Jewelers. That was the first time any player in the industry other than Titan got serious funding. You have to reassess. But after every reassessment, we came to the conclusion that directionally we are still right. Yeah, it is not one thing. And at different points of time, different things were added and subtracted from that differentiated insight. Great. Thank you, everyone.